The rally in the market in the first half of 2023 was largely powered by some of the largest companies by market cap, including a 45% return in Apple and an over 200% return from Nvidia Corporation. Another mega cap that had a solid first half of the year is Walmart, stock ticker VMT, currently trading at $158. Year to date they are up 10.26%, and over the last year they are up over 26%. They are almost at the top of their 52-week range, and if you look at the dividend history, they do have 49 consecutive years of dividend payments and 49 years of dividend growth. And if you look, they really had a massive dividend growth streak going on from the year 2000 up until 2013-14. Ever since then, they have just raised it by 1 cent, so it has started to grow more slowly but surely. On Wall Street, the consensus between the analysts is that Walmart is indeed a buy or at least a hold. Between the 42 analysts, there is 22 with a strong buy, 12 with just a buy rating, and 8 with a hold rating. No one has a sell rating on Walmart. But if we look at the price targets, the average price target is $170, which only indicates a 7.8% upside roughly. It looks like you could be overpaying quite a lot for some limited upside. But let's jump into our stock screener and take a closer look at Walmart to see whether or not it could be a good buy at the current levels. So having everything loaded in, I'll take a quick look at some of the key metrics, and what I first see is that the EPS growth over the last 5 years is indeed negative, not something we would like to see. Also, the PE ratio going forward is close to 23, which is a quite high multiple, but compared to the 5-year average, it's actually a 20% discount compared to that. They do have pretty good revenue, and as you can see, the revenue on the 5-year CAGR is steadily rising 3% yearly. And I would believe that the revenue is mainly growing due to inflation, because if you take a look at the margins here on the right, you can see the operating margin and the profit margin are quite low, only sits around 4% and 1.8%, and operating margin has actually decreased over the last 5 years. So they are also feeling the pressure from reducing margins due to the headwinds in the economy. As mentioned, some of the dividend stats it sits around 49 years of dividend payments. The current yield is 1.44% with a payout ratio of around 54%, just shy of the 60% limit I would like it to be below. At the 5-year dividend growth rate 1.56, extremely slow grower as we saw in the dividend chart. Net debt to EBITDA is looking extremely good. It sits at a comfortable level way below the 3% or the 3-year ratio mark I would like it to be at, so 1.66. I think return on invested capital and return on equity is quite low. I would have these at least double for invested capital and also possibly a bit higher on return on equity. It sits around comfortably around their average, but I really think these two should be way higher. Jumping into some of the dividend data, as you can see here, the dividend growth rate is indeed very, very slow. 10-year growth rate just 1.8%. So if you come down here to the dividend yield theory graph, you can also see that we are actually below the line. So at least according to dividend yield theory, it is indeed overvalued at the current time. No discount to be had based on this theory at least. But to support that, we also had a lot of other valuation methods. One of them is the discounted cash flow. And if we look at here, we take the free cash flow from the different years. We then apply a growth rate to project those free cash flows into the future. We discount them back to present value using a discount rate of 9%. Combining cash equivalents, the total debt, and the shares outstanding, we arrive at a fair value of $78 for Walmart. Next one is the dividend discount model, where we do take the dividend payout from the different years. We then apply a growth rate into the future, and seemingly so, I would guess it will be 58 cents next time. So combining that with the weighted average cost of capital, we do have an intrinsic value of $42. The multiples valuation, where we take some comparable companies and using their PE and EPS, we then arrive at a stock price of $99 for Walmart. We also have the Graham's revised valuation model, where we take the formula here on the left. We then use a PE of no great company, the growth rate projected for Walmart, the average yield of AAA corporate bonds, and the current yield of AAA corporate bonds. We then arrive at an intrinsic value of $48.54. We also have the price to earnings valuation method, where we do take the price to earnings ratio and compare that to the trailing 12 months EPS. We take an average of the PE ratio. For some reason, the data I have doesn't have the historical PE ratio, so I would jump over this one and jump directly into the free cash flow valuation, which is kind of the same, where we take the price to free cash flow ratio. We then use the last 5-year average. Combining that with the free cash flow per share, we arrive at an intrinsic value of $128. Lastly is the Peter Lynch model, where we do take the growth rate, the dividend yield, the PE ratio, combining that in the Peter Lynch formula to arrive at an intrinsic value of $47. Before we jump into the summary, thank you so much for watching. If you haven't done so already, please subscribe to the channel for more videos in the future. Now let's jump into the summary and let's zoom in a little bit more. Again, you can see here we do have all our valuation methods. We have also included the analyst target price in this one. As you can see here, the PE multiples didn't provide us anything, so we will exclude that one, which means the average of the valuation method we do have remaining just sits at an average of $74, way below the current price of $158. Actually, an average current discount 113%. On top of that, we also want to provide a margin of safety. We start here with a standard of 25, as you can see in the calculator on the right. We then deduct or add something based on some of the key metrics. As you can see here, we deduct 10% in the margin of safety due to the EPS growth. We also have the 5-year dividend growth rate, the payout ratio, and so on. And in the end, it arrived at a margin of safety of 20%. So if we add that over here, we actually get an acceptable buy price of $59. Obviously, a behemoth like Walmart do warrant some premium due to the size of the company and due to their several years of performance and due to their several years of returning value to shareholders, as you can see in the 49 years growth streak from the dividend, and also the do buyback shares and a lot of other stuff. So taking everything into account, it do look like a company you would be okay buying at a premium because it has shown resilience and do provide a lot of value back. But I think at the current trading levels, Walmart investors seem to be overpaying for limited earnings and revenue growth, also due to the low margin. So I have some difficulty seeing why some of the analysts still rates this as a buy. But if you take a look at the current target levels, the price target levels, they were also just 5 to 10% above what the current price is. So it seems there are some very limited upside, and then pullback of 10 to 15% could easily come if they miss the next earnings report. So for me personally, I would steer away from Walmart at the current time and at the current price levels. Thank you so much for watching, and I'll be seeing you in the next video.